Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds in Melbourne, and this is a review of markets in April 2022. Well, a horrible month for asset markets in general over the course of April, with bonds, corporate credit and equities all suffering losses over the course of the month. And this is mainly on concerns of global recession, which is now considered to be fairly likely towards the end of the year or into 2023. And this is all as a result of central bank policy materially tightening financial conditions, trying to quell inflationary pressures. We've spoken about this all year, about the removal of crutches from underneath the market, the triple removal of quantitative easing, of essentially zero interest rate policy around the world, and then finally of those huge fiscal stimulus periods. And in that process, obviously the bond markets led the underperformance of a lot of asset classes, and they were on the nose first, but certainly other assets are now really playing catch up. And we've long considered that the bond markets is that freight train on the front of a really long series of financial assets. And where bonds go, ultimately other things will be dragged via discount rates and funding rates, and in the corporate credit market around refinancing of corporate debt. And that's the big one that's starting to percolate through and cause a lot of concern in the worlds that we monitor. If we look at something like US corporate bonds through the month of April, they had a minus 5.5% return to be down 13% on the year. That's just extraordinary given that we haven't really had any kind of seizure moment yet. And we know from periods like 2018 at the end of the year and early in 2020, when we get into a big risk-off sentiment, that corporate credit markets are a market of confidence. And so sadly, they are calibrated by the weaker players in that field. And when the markets are no longer willing to roll existing debt obligations forward, i.e., you owe us money on Monday and we're not going to relend it to you and we'd like to be repaid as well, similar to the Eurozone sovereign crisis, then clearly things can go into a very dangerous tailspin thereafter. Now, the big problem this time is that when that has occurred, central bankers come riding over the hill and they quickly cut rates and they provide quantitative easing, they crush volatility and they provide confidence, and the markets start to heal. We cannot do that this time around if inflation is still coming down from what is 9% in the United States, 5.1 here, and it's only on its way back to still be well above the central bank mandate for what is acceptable. It's much harder to provide that support mechanism this time around. So we do think that it really requires quite considerable thought to think through. I would imagine that if we do get that seizure moment, then things can take a turn for the worse, and clearly liquidity and credit quality, asset quality, all of those types of things are going to become so paramount again in the latter part of 2022. It does look like we're absolutely on that road. So the Federal Reserve are expected to move their own Fed funds rate, similar to our RBA cash rate, to about 2% by the summer recess. So by the end of July, only a few weeks away. Now that is an incredibly fast rising of monetary policy rates. Remembering, of course, in 2018, when the world was peaceful and stable, hug thy neighbour, buy their energy, lowest cost producer everywhere, but certainty, really did reign supreme. We could only get to 2.5% before we had that credit problem at the end of 2018, where global credit markets seized and there was no high yield issuance from the weaker borrowers in credit markets through the month of November. It generated very big equity drawdowns at that time and forced the Fed to switch their policy in January 2019. Fast forward to today, and clearly a much more unstable world. Global conflict, much more uncertainty. Just in time can no longer be relied upon. It's switched to just in case, and all types of things to consider. What no doubt will be a very volatile environment in both inflation data and economic data, and much more boom-bust type cycles that we'll see from this very volatile delivery of these types of economic data as the world reopens, as things are starting to normalize, but impacted by extraordinary moments, and certainly we've had that over the course of 2022. We knew that things were going to run really hot in the reopening, that monetary and fiscal settings were far too accommodative once the health crisis had passed. But that slammed straight into global conflict, caused an energy and a food crisis, which was, they're globalized markets. It does affect us down here, not as much as if you live in Europe, but certainly affects us nevertheless. And then right behind that, the Chinese lockdown, which frustrates global supply lines again. Not a total global lockdown this time, but still something that can meddle with the data delivery and no doubt will cause more inflationary pressures over the medium term. So all of these things the markets are fighting around with, and we know that the only way central banks can try and deliver us lower inflation outcomes is to use a real hammer blow of a tool in monetary policy to utterly destroy demand. Now, that is to take the pressure off the supply line. The central bank can't print us more oil wells or more inventory or more ships or containers, but they can destroy the demand that takes the pressure off the delivery of those things. But this is like scratching a mosquito bite by swinging an axe. It is a dangerous way to go about things, and that's what the markets are really worried about at the moment. You are probably going to destroy inflation, but you're very likely to destroy the economy in the same process, and you will leave us with a global recession, and it's hard to re-energize that complex if we still have inflation outcomes which are higher than we've previously enjoyed. Now, the central bankers tell us that they can do all this and engineer a soft landing. We just believe that it is such a highly complex series of events that are occurring. A lot of these things are, still at the mercy of the thoughts of a few very powerful global leaders. It's very difficult to predict how that might come out, with any certainty. So we are much more cautious on that process. But certainly to this point, the RBA have got off the line and hiked in the very first days of May. We know that they're going to keep going. The Federal Reserve looks set to really accelerate their hiking program, as we said, to get to 2% from essentially zero, but it'll be there by July. And we know that, as I said earlier, in a much more stable environment, we couldn't get much further than that before we had a very, very big problem collectively as a marketplace. The only thing that we think is certain is that there will continue to be a lot of volatility, but certainly over the course of this year, it looks like all asset markets are lifting risk premiums as a result. There is this uncertainty. They do require more return, and sadly for all asset owners, that means lower prices. Bonds have led that process into the year so far, but you're now seeing the real slingshot catch-up moments from other markets like corporate credit, like equities. And we do just remind folks, I know that it's been a frustrating journey with fixed income, but these are, particularly when you're looking at sovereign fixed income, incredibly liquid, and they usually have a good negative correlation to these very risk-off moments. We're starting to see that the day that we're filming this, where bonds have actually rallied pretty hard for the first time in a little while, whilst equity markets are falling, crypto's collapsing, these types of things. Now, where it all lands, we simply don't know. If there's regime change in Russia and the war finishes, we could have a raging bull market by the end of 2022. Everything is possible, I guess, this year. There is just so much uncertainty. We just think that diversification still makes an awful lot of sense. If you have very strong opinions, go for your life. But, there are just so many different parts of this complex environment and water flowing under the bridge. It's very, very hard to have any certainty about outcomes, other than to say that diversification is, I guess, a bit of an each-way bet in these uncertain times. Thank you very much.